Cryptocurrency is all the rage these days. The immense craze, constant hype, and lucrative profits are what make cryptocurrencies an ideal investment option. But always remember that investing in crypto at the right time takes luck, but more importantly, insights and precision. Only those who improve their investment methodologies every day, one mistake after another, consistently crush the masses. So, if you have money to spare and you're willing to try a high-yield but high-risk investment, you might want to look at cryptocurrencies. But before you do, you must be warned that these digital assets are highly volatile, and there are equal chances of earning big or going bust. With that in mind, it is important to educate yourself about crypto investing and minimize mistakes to get ahead in the market. Hey guys, and welcome back to Investing Few. If you are new to this channel, please like, subscribe, and press the bell icon to get new video updates. Make sure to do so if you want all the latest news on cryptocurrency. In today's video, I will share a list of common mistakes to avoid when one invests in the highly volatile crypto world. So, without delaying the inevitable, let's jump right into the video. Number 1. Don't overtrade. This is one of the most frequent mistakes that most of the crypto investors usually make. Some investors, mostly beginners, want to make 20 trades a day. This is dangerous. Ultimately, many of them lose from fees or because they make bad trades and then trade more to recover their losses. The reality is that there aren't 20 good trading opportunities a day. Trading too much leads to poor decision making. Overtrading also increases your tax liabilities. Also, lots of investors are impatient and cut their losses early because of emotions. The cryptocurrency market is made of cycles, where prices rise and fall drastically. If you buy high, then you will need to wait out an entire new market cycle to end up with profits, meaning a new bear, then bull run, which can be well over a year of waiting. For that very reason, never, ever risk the money you can't afford to lose. This is the basis of crypto investment. Number 2. Chasing cheap coins. Another big mistake that a lot of new investors make is that they spend their money on chasing cheap altcoins in hopes of getting big returns. Never, ever do that. Stop chasing cheap coins with dreams of Lambos and private jets. Lots of uneducated investors in the crypto space buy low-priced cryptocurrencies because they think there is high chance of getting large profits. This is a common trap. There are lots of factors that affect a coin's price, including two important ones: the circulating supply and the real-world value of the coin. And never invest in an altcoin unless you can fully identify these two things and how they will impact that coin's performance in the future. Number 3. Investing in just one crypto. There is no doubt that Bitcoin is the holy grail of cryptocurrencies. While it's having a pretty decent run, it does not mean that you should invest in Bitcoin alone. Therefore, it is best to diversify your digital assets. You should try to figure out other altcoins and what services they are providing. Many other cryptocurrencies can offer you good returns, like Ethereum, and can prove to be a fruitful investment. Just remember, you shouldn't put all your money in just one crypto. Much like the old adage in investing, don't put all your eggs in one basket. Try to diversify your investment portfolio, but with a lot of research and careful attention. Number 4. Investing without research and proper understanding. Whether it's cryptocurrency or any other asset, the most important thing to remember in investing is to educate yourself and understand what you're getting yourself into. Before you even invest a single cent, you need to allocate some time in learning about the basics of crypto investing. Crypto investment remains unpredictable and risky, and if you don't know what you're doing, you can end up losing money. Let me share some of the basic things you need to know about crypto money. It's completely digital, and therefore it is not physically represented like metallic coins or paper money. In fact, cryptocurrencies exist only in the digital world or in computers. It's universal. You can use digital money across different countries and borders. If you have Bitcoin, for example, you can pay a seller in Australia or Morocco who's also using it. You don't have to think about exchanging it for local currency, such as Australian dollar or Moroccan dirham. It's peer-to-peer. A crypto transaction only occurs online, so you can only transfer digital money to another person virtually. It's decentralized. You have the sole responsibility of keeping track of your own crypto money. There are no central banks and financial institutions that govern or protect cryptocurrencies and the investments therein. It's encrypted. The reason why it's called crypto is that it is hidden. Users are given long strings of alphanumeric codes and are not even required to use their real names or addresses to open a crypto investment. So if you invest in this type of asset, you should know that you are responsible for your own money. If you encounter problems with your investment, you can't get assistance from your central bank, the Securities and Exchange Commission, or a depository insurance company, because crypto is completely decentralized and unregulated. Number 5. You are diverted with media propaganda. Beware of media deception and fake news regarding different cryptocurrencies. Major news sites will sometimes release very negative and often threatening news. Deceiving headlines are the foundation for propaganda. A lot of these news websites are intended to generate clicks, controversies, and sometimes even FUD. It's often very exaggerated, so don't get diverted by this false information. Number 6. You don't understand market dynamics. Another key mistake in crypto investment is that you don't understand the market trends. You should know that Bitcoin only makes up about 50% of the market's liquidity. There are thousands of altcoins, and they work in correlation with Bitcoin. Not understanding these correlations can lead to poor and costly investment decisions. Those who make money trading crypto understand these dynamics like the back of their hand. So it's important that you should know about all the relevant market trends and take your decisions on the basis of what market predicts for that cryptocurrency. Number 7. You don't own a hardware wallet. Owning a hardware wallet for cryptocurrencies is very critical. I will be straight up. If you've invested more than $500 in cryptocurrencies, then hardware wallets are a smart investment. They are disconnected from the internet, which means that hackers can only obtain your funds if they steal your physical device and also know the passphrase to access it. This makes security a much easier task. Always remember, you should never compromise on the safety of your crypto investment. Number 8. You cannot read trading charts. If you cannot read technical charts, then start learning today. Once you understand some basic dynamics, such as supply and demand, it helps to start learning how to read trading charts, also known as technical analysis, and more importantly, how to relate the fundamentals of the project with these charts. Technical analysis backed by solid fundamentals and financials of the project may help you better predict the future by analyzing historical data. You'll gain a feel for when markets are about to turn or if assets aren't priced properly. Number 9. Making crypto investment decisions based on emotions. This is one of the most critical points that you need to remember. There are 3 terms, HODL, FOMO, and FUD, that you will encounter in crypto investing every day. Each of these represents some kind of strategy, but are emotion-driven at the same time, which should not drive your investment decisions. HODL means to hold on to your investment no matter how volatile the market is. This is okay, but sometimes you just don't have time to wait for a good return on your investment. When that happens, cutting off your losses is a better choice. FOMO, or fear of missing out, means buying on the hype because you just want to follow the trend. This is the most dangerous one because you would be susceptible to fly-by-night schemes or scams. Lastly, FUD stands for fear, uncertainty, and doubt. FUD may prevent you from investing in crypto, even if the research stats or market sentiments are telling you that it's a good time to invest. So, never be emotional in your crypto investment. Risks are a part of these cryptocurrencies, so don't make a stupid decision just because you get scared of market volatility. Instead, look at the long-term prospects of your investment. Number 10. You don't use 2FA. And lastly, we have the two-factor authentication. A very crucial step when working on your cryptocurrency investment strategy is to reinforce the security of your cryptocurrencies. Enabling 2FA on every sensitive website is the most important habit you need to adopt to increase the security of your accounts. Always remember, without proper security, your investment is always at risk of being stolen. And with that, we come to the end of today's video. What are your thoughts on these common mistakes that people make in crypto investment? Tell us in the comment section below. Also, drop your suggestions or feedback for the upcoming videos. And make sure to give this video a huge thumbs up if you enjoyed. Thanks for watching.